today we've got a very provocative question that we're going to be asking, and that is your financial plan lying to you? And we're going to examine whether a lot of the assumptions that are being made about return potentials and probabilities are actually appropriate. Are they realistic? What are some of the flaws in some of the financial planning software that is out there that may be painting a completely different picture on paper for investors as they're preparing for their financial future versus the one that they may actually meet in real life? We're going to dive in. So today's agenda, right, we're going to examine what assumptions are underlying a lot of financial plans out there. We're going to talk about the randomness of markets and why order matters. By that, we're really talking about sequence of returns. And then we're going to end with some ideas of how do I improve my likelihood of success. So here we go. The issue that I have with a lot of financial planning software, and it's really just the way that they have to go about making a lot of these calculations, is that they make linear assumptions about where markets are headed in the future. And so this table that I've got on here is something that I pulled from Mercer Advisors. And so Mercer, provides a lot of data analytics to a lot of financial planning software and to a lot of companies to help them set their capital market assumptions. And I want to kind of examine the way that these numbers kind of fold out. And then I, kind of debate the idea of, is it really appropriate to have these linear forecasts for where these asset classes are going? And I guess in the long run, that's the best that they can do. The best that they can do is say, we're expecting that these markets are going to return X. Perhaps they've historically returned X. And then we've got this standard deviation over here of, and the idea of standard deviation, if you're not familiar with it, is that in 66% of outcomes, right, in a normalized bell curve, that we should see that 66% of the outcomes that the return for, let's just say, non-U.S. fixed income, which they suggest is going to annualize over the next 20 years at 3.25% a year, is going to be somewhere between 11.45, which would be this, right, plus this. And then the other side of that is going to be somewhere around -5. So 66% of all outcomes are going to fall into that range. And then they'll do some Monte Carlo simulations underlying that to try to represent maybe what an actual outcome is for investors. But the problem that I have is that a lot of the software and the planning and projections that go into a financial plan for investors, they show linear returns. They would suggest, based on the asset allocation that we're going to use for this particular client, this percentage of U.S. equities, international, fixed income, commodities, private markets, whatever it is, that portfolio on average should return this with this standard deviation. And all it is a weighted average of the numbers that are here on the screen. And they'll take that information and they will plot it in cash flow worksheets, and they'll say, you're starting this year at this value, and if you earn an average return, you're going to expect this amount of investment return. This is how much you're going to spend. This is what your portfolio value should be at the end of the year. The problem of it, that it's very clean on paper, but it doesn't work that way. The markets don't work that way. Life doesn't work that way. If we could find linear returns, our job would be very easy, but they don't exist. And so my concern is that a lot of people are putting a lot of faith that what their average return is going to be is something they could count on year in and year out. The alternative to that, right? Or let's look at, maybe before we get there, how do historical returns actually compare to these capital market assumptions? So we did some analysis here just looking at the S&P as an example, and we've got both a 20-year rolling return and a 30-year rolling return for the S&P. And so if these static capital market assumptions for, say, for large cap U.S. stocks, so notice that they don't even delineate. So large blend, they're expecting 7.5%. Same for value, same for growth. How has that worked out in the last 10, 15 years? Growth and value certainly have not experienced the same return. If they're supposed to over the long period of time, that doesn't really bode well for the growth category right now. But if we look at, over the last 20 years, right, looks like the S&P has average rolling return of a little over 8%. Not bad. That's probably right on its historical average. Basically the same thing for the rolling 30-year return. But notice that this isn't a flat line, right? If we're expecting, say, 7.5 is what that expectation was, there can be some meaningful deviation from that, right? Imagine for down here in 2018, the rolling 20-year annualized return was sub 4%. So taking you all the way back, that if you're a buy and holder and you retire in 2008, or you retire in 1998 rather, 1998 forward, buying the S&P, you're annualizing at less than 4%. I'm sure your expectations for returns were meaningfully higher than that when you did your financial plan back then, right? So your rolling 30-year number at the same period of time was close to 8%. It was north of maybe that 7.5 that you were expecting. The problem is that's not the time period you got to live through. And if this happens to you, and we're going to talk about it in the sequence of returns part of our discussion today, this is where things can go very wrong for you as an investor. And so that's why I don't think that we should be putting too much faith in these linear expectations for where markets are going. No, I think we need to have something that is more dynamic. And so there are a handful of companies out there that do this. One that I'm quite fond of is Research Affiliates. This is Rob Arnott's group. And so they're giving advice to the largest pension funds, endowments, foundations in the world about how they need to be allocating their capital. And they're not taking 20, 30-year views necessarily on what these assets should return. They're looking out over the next 3, 5, 10 years. They have all the historical data. And so they've got an understanding of what these asset classes return on an average basis, what type of risk or volatility they experience. And based on the way that they've performed in recent years, over the last 1, 3, 5, 10 years, compared to what their historical returns are, the likelihood is that we're going to see some sort of a mean reversion. So I want to jump over and just show you a live look at this. If you're not familiar, certainly get familiar. So you go to researchaffiliates.com, just go to tools in this asset allocation interactive, and you can add a bunch of different asset classes on here. So I've got things like cash, we've got fixed income, right? So we've got treasury, we've got credit positions. So here's, U.S. corporate intermediate duration bonds, emerging market, local currency bonds. One of the top performing asset classes you see going forward, and we're looking here in real terms. I can change this to nominal. So I encourage you go here and play around with it. But so they're expecting ex-US small cap stocks to annualize at 8.3% over the next 10 years with a standard deviation of 17.3. But they've got large cap US stocks down here over the next 10 years with an expected rate of return of 3.1. And so, but if we say, look, instead of where do we think these things are going, what if we look and see what they've done over the last 10 years? Large cap US stocks, we talked about this on the show last week when we were in part of the mailbag segment. People had questions about how do you encourage investors, clients to allocate away from US equities, particularly large cap US equities when they've dominated. And that was what the white paper, Pavlov's New Dog, was all about, that people have been conditioned to accept that dominant performance in their investments runs through large cap US stocks, and particularly the growth category. And that's been the lived experience over the last 10 years. It dwarfs everything else. Large cap US stocks annualized 15.6. You've got ex-US annualized at 10. And so the compounding difference here, it's not anywhere close. The issue is when you have a sustained period of outperformance like that, you're going to get some mean reversion. Because if the expectation longer term is U.S. equities return 8%, 8.5%, 9%, what's going to happen, right? We're going to have U.S. large cap equities go from annualizing north of 15 to the next 10 years just to bring it back to normalcy. We've got to bring it down to 3. So that's the expectation. And so what I think that investors need to be focusing on in terms of their financial plan and how they're building their allocation right now is that it's in some ways understandable to consider linear expectations for what asset classes might perform, because the systems can't do that many calculations, right? They can run these Monte Carlos to say, well, in any given year, this asset category can do this, it can do that. The problem is, and they always talk about, well, we run 1,000 iterations or 5,000 iterations. Your clients don't get that many, right? If they're 60 years old, if they live to their 90, they get 30 cracks at it. And so if they have a bad year or two, it's devastating. They don't get the law of large numbers. They're not on their side anymore. And so I think it's more important that we as advisors are considering something a little more dynamic in terms of our expectations for what asset classes might return year in and year out. And so instead of anticipating, hey, U.S. equities over the next 20 years are going to return 7.5% on average, and that looks reasonable compared to everything else, I'm just going to stick with that. The problem is, if you can't make it through the next 10, it doesn't matter what happens in the next 20 or 30. And so you need to consider some of these other asset categories up here, like small cap US, emerging markets, small cap international, developed international stocks, whose expectation is double or more what we could potentially see out of U.S. equities. Okay. All right. Go and play with that if you haven't had a chance already, because it is worthwhile. Okay. I want to talk about sequence of returns. We've already hit on it a little bit, but markets are random. They shift, and you ultimately need to be adaptable over time. But our industry tells you always just got to hang in there, ride it out. And when you're in the accumulation phase of life, then what happens in the market from year to year, perhaps it's not quite as important. So here we're looking at a chart of 2 different portfolios that have the same annualized return. These are both returns that the S&P 500 actually experienced from 1969 to 1994. But they're just inverted. So portfolio number 1 starts in 64, runs through 94. Portfolio 2 starts with the return from 1994 and just runs the race backwards. But so, of course, it's just math. They annualize the same thing. And so over time, they end up with the same value. They take little divergent paths, but they end up in the same place. And so when you're in accumulation mode, perhaps this doesn't matter as much. This isn't really a major risk, the order that your returns happen in. It is the complete opposite story once you get into distribution mode, when you need your money. And so now we've got 2 portfolios that start off $500,000. They're taking $30,000 out each year and increasing that distribution by 3% a year to account for inflation. And notice we're not in the same ballpark here anymore. The difference between portfolio 1 and 2, it's not just a couple $1 million. It is success versus failure. And I'm going to tell you, it's a coin flip for too many investors out there right now. It doesn't matter that both of these portfolios annualize at 11.3%. It doesn't matter that the good returns that portfolio 1 could have encountered in the later years, they will not be able to offset the declines that happened early on. I remember, I'll tell you a story from my freshman year at Georgia Tech. And I was playing a lot of video games my freshman year at Georgia Tech. And my first semester, I made a 3.2. So I was taking 5 classes, 15 hours, made 4 B's and an A. So made a 3.2. And wasn't really going to class a whole lot, but I was an auditory learner, and so I felt like, if I just pay attention, I'm going to be fine. And I was. Second semester, that really bit me. And I was staring at the business end of some really bad grades and ended up having to pull myself up by the bootstraps and manage my way to 3 B's and a C. Made a 2.71 and had a cumulative weighted GPA of a 2.96 after 29 hours. Now, I was the last class of students that in the state of Georgia, you get the Hope Scholarship if you have certain grades going into college, and as long as you have above a 3.0, you get to keep it. So I had the Hope Scholarship. But my class was the last one to be evaluated after 30 hours. I only had 29. Took 15 first semester, 14 second semester, had a 296. So I wasn't going to get evaluated until the following semester. And I ended up in the fall, ended up making 3 A's and a B, made a 375, never looked back, ended up graduating with high honor. I graduated with a 353. The problem is I wanted to graduate with highest honor. I needed a 355 or more. But I could not, late in my collegiate career, there is not enough I could do to offset the bad semester that I had second semester of my freshman year. I wasn't going to be able to overcome that. And in investing, even though the outcomes can be a whole lot worse, right? Ultimately, I'm just talking about grades. Here we're talking about the ability for somebody to be able to live out the remainder of their life. What happens early is incredibly impactful. It doesn't matter what the long-term expectations are for what assets are going to earn. What matters is the path that you encounter them. Because if you encounter the wrong side of that average early on, you're cooked. If you can't get through the first 10 years, then what it makes in years 20 and 30 are irrelevant to you. You never get the opportunity. Here's just a breakdown of what these two different portfolios look like. So we talked about how, so portfolio one started in 1964, ran all the way through 1994, I believe. And so we just invert those returns. This one starts with a minus 8.4, ends with a 1.32, or 1969 to 1994. This one started in 1994, ran through 1969 backwards. So they're just inverted. And so you notice that if there's no withdrawal, the balance with no withdrawal, it takes a different path, but they end up with the same number. Okay. 6,159,462. So if you're not taking money out, then you can say, man, really not as concerned about it. And the reality is you can be right. You can be right. Now, you could probably improve your balance over time. We'll talk about that here momentarily. But if you're taking money out, if you are taking distributions, then the order that these returns befall you matters a great deal. This person will not have any money in year 27. They're out. This person still has 2.5, almost $2.6 million. And it's only because this person right here, they had a couple of bad years in years 5 and 6. They didn't get started off on a good foot either. They were down just 8% in year 1. But it's really years 5 and 6 that really did them in. Right? That's where things really started to spiral out of control. So, right? How do you improve your odds of success? Well, sometimes the best offense is a good defense. Risk management should be priority number 1 for investors. In our mind, whether you're in accumulation or distribution mode. You could still be in accumulation mode, and if you can find a way to minimize the impacts of a bear market and start the next bull market with more capital, you're going to be better off in the future. But if you're in distribution mode, it is imperative that you're playing defense when the markets are not your friend. When the trend is not your friend, you better be playing defense. Right? Number 2 is understand that markets are cyclical. They go up and down, and nothing lasts forever. The way that you allocate your portfolio, as a result, it should evolve over time. There are too many closely held convictions that people have in their portfolios. We see it today, right? We can champion the US of A and shout out to our hockey teams. Awesome. Gold medal. Doesn't get any better than that. But there's way too much bias here in people's portfolios today. We see it constantly. And it's not even of their own volition sometimes. It's in things like target date funds that they have in their 401ks. Our industry, the passive overdose that happens in our industry has just accepted that more money is going to be going into U.S. equities. And I think it's a mistake, because the likelihood is over the next 10 years, those allocations to U.S. stocks are going to meaningfully underperform the rest of the world. But have you made that shift in your portfolio? The way your portfolio is positioned today should look distinctly different from the way it looked 5 years ago, 8 years ago. We talked about that in one of our prior episodes about how can investors or financial advisors incorporate technical analysis into their business? And we said, just the intermarket analysis alone is pivotal. You align with those intermarket trends, and that is going to help you allocate your capital to a place where it's likely to be best rewarded. And right now, that means that you effectively have to take the field. You want something other than large cap growth stocks as the largest positions in your portfolio. Stay diversified, of course, but do not forsake these other areas in your portfolio. Small cap, mid cap, international, emerging markets, real estate, commodities, bonds, right? Bonds, so many people have been bailing on the bond market over the last 2 years because bonds haven't gone anywhere for 5 years. Now, perhaps over the long period of time, bonds are not going to be the buffer to your portfolio that they once were because we're starting with rates at much lower levels. But that doesn't mean that in this window of time, bonds can't be very profitable. Since the end of 2023, when interest rates peaked out and everybody was getting flushed out of the bond market, now they were concerned about their duration risk. The Barclays aggregate bond index is up close to 7.5% a year. It's pretty good. I mean, you're talking about pushing on the expected annualized returns for stocks. You've been able to get that in bonds over the last couple of years with a lot less risk, a lot less volatility. And I'm not saying that that's going to last forever, but that was an opportunity if you didn't get flushed out. So understand that your portfolio needs to evolve over time to be aligned with the secular trends. Okay? The last piece is you need to have a process and focus on that over trying to guess where the markets are going. So the views that we have at Reveille about wanting to favor or have more exposure into things other than U.S. equities, it isn't just a opinion or a belief that we have. It's rooted in what our process would lead us to. And that when we look at these intermarket trends, you can see that balance has shifted and rolled over. There was a great chart that I saw a couple days ago from Grant Hockridge where he showed the long-term relative trend of U.S. versus emerging markets. It is flipped. It's been about as persistent in favor of U.S. equities since 2010, 2011. And you've got the emerging market index just now breaking out above its 2007 highs. Hasn't gone anywhere for 18, 19 years. And it's been left in the dustbin for way too many people because every time that they've chosen to allocate to it, it's just disappointed them. So we as human beings, we're emotional creatures. And that oftentimes is antithetical to good decision-making as an investor. And so investors, they tend to make mistakes that can really be classified into one of two categories. The first one is you make changes to your investments when you should be sitting on your hands. The second is you sit on your hands when you should be making changes to your investments. I think that's the prevailing mistake that is being made today. That too many people, things have gone very well for people over the last decade or so in their 401ks or just with the passive things that they've done if they've had exposure to U.S. equities. And so they feel no urgency. They feel no urgency. The problem is you should feel some urgency to make a change there. So, but look, both of those mistakes, whether you emotionally go and you change your portfolio because maybe something bad has happened or you just can't take it anymore, or you just say, nope, not going to do it. It's been too good to me, or whatever it may be. Both of those mistakes are rooted in emotion, hubris, or some sort of closely held belief. But that is why, if you have a process or a methodology by which you arrive at your actionable investment decisions, and you're routinely employing that, and that is leading you to decide if I'm invested in the market, how I'm invested in the market, that is going to be key to the success that you're going to have. That's how you're going to improve your odds of success, is try to take yourself out of it. Try to have as many of the decisions that you make be mechanical. Have them be process oriented, because your process is going to stay much more open-minded than you are. And then you've got to stick to that process. Your ability to stick to the process is as important as anything else that you're going to do. Okay. All right, guys. That is it for today. Appreciate you joining us. And again, if you're a financial advisor out there, if you are not familiar with the research affiliates, check it out. It's a great tool. Strongly encourage you to use it and see how it may challenge any of the convictions or beliefs that you may have. But we appreciate everybody tuning in. As always, feel free to email us, send us your questions. We'll use them in a future mailbag segment, info@reveillewealth.com. Thank you again, everybody, for tuning in to today's show. Once again, I'm Stephen Weitzel, and we will see you next time. Take care.